Welcome to WAM Vault. I'm here today with WAM Alternative Assets Portfolio Manager Dania Zinurova. Dania, it's been a really busy year for WAM Alternative Assets. Can you give us an update on the portfolio?
Indeed, very busy period for us, and the portfolio has continued to evolve. One of the areas of focus for us has been to reposition the portfolio, reduce a fairly concentrated exposure to water rights. So we've been successful in implementing the strategy where we started redemptions out of the water rights strategy. And the goal is really to have around 15 to 20% over the medium to long term in this asset class. I still love the asset class. It has a number of really attractive benefits for the portfolio. However, I've been focusing on including more diversification in the income part of the portfolio. So as we stand now and we look at the portfolio, we have water rights, we have private debt, we have core infrastructure and core healthcare real estate in the income producing part of the portfolio. At the same time, as we continued exiting matured private equity investments and infrastructure investments, we reinvested capital into new investment opportunities. And we partnered with high quality investment teams such as Allegro Partners, Adamantum, and others. And with them, we are deploying capital into private equity turnaround and transformation, into mid-market buyout opportunities, and others. So the portfolio is really well positioned to withstand current uncertainty in the macroeconomic environment and current volatility in the financial markets.
We're now well into FY23. How are you positioning the portfolio?
Well, the good thing about alternative investing is that it's a long-term investment strategy. And what we've been doing over the last 2 years and over the last 4 to 5 months is really identifying those new investment opportunities and committing capital. However, in alternative investment world, when we commit capital, it doesn't mean that the capital is invested immediately. It does take time to find those investments and to deploy the capital. So when we look at the portfolio, we have a very good level of cash, which means we're well positioned to tap into new investment opportunities over the next 6 to 12 months. And we will continue deploying capital in healthcare real estate, last mile logistic, in infrastructure, private debt, and other new investment deals that we find. I would also add that looking at the recent exits of the matured investments, the portfolio has delivered really strong investment returns. And our profit reserve, as at the end of September this year, has been at about 20.9 cents, which is a strong dividend coverage ratio that gives us certainty over the dividends for the next 5 years. And historically, Wilson Asset Management has been really focusing on paying sustainably growing, fully franked dividends to our shareholders.
Can you talk us through any recent exits?
Yes, sure. Well, we had an excellent, I would say, stellar exit. And just to clarify, when we talk about exit, that means an investment has matured and we are ready to sell our position in this investment. In alternative investment space, we refer to this as exit. One of the most recent one was Shopper, and that was an investment made in 2017 by one of our investment partners, Fortitude Investment Partners. It's one of the fastest growing offline media business in Australia. Fortitude Investment Partners has really successfully implemented the growth strategy with the business and worked closely with the management team to grow the business. We exited the business to Cartology, which is one of the leading media business owned by Woolworths. And the performance speak for itself. The exit was above carrying value, and we were really glad with the result of this investment. Another 2 exits were in infrastructure and real estate. So In the US, we own a business called Volta, which is one of the leading energy storage business in the US, servicing large-scale energy providers. And it's been a business experiencing very strong growth over the past few years. With investors focusing more and more on energy transition, there was really strong demand for this type of business. So the business was exited as well at premium to its carrying value. And another recent exit was a real estate industrial asset in New South Wales. The investment was managed by one of our investment partners, Centennial Property Group. Excellent timing in terms of the market positioning. We saw strong demand and they ran a competitive bid auction. So the result was, again, exit above carrying value.
And Dania, what about any new investment partners this year?
We did commit capital to a new investment partner, ICG. It's a global leading alternative investment manager. And they really specialize in private debt in Australia and in other regions. For me, this asset class is really important in terms of having exposure to it in the portfolio. Because when we look at private debt, usually the deals are structured as floating rates, which means as interest rates rise, we see this increase in income returns coming from private debt. So I really see it as a very good interest rate hedge within the portfolio.
Those new partners sound great, Dania. So what are your plans for the rest of the year for the portfolio?
Well, the rest of the year, I'm really planning to continue focusing on growth opportunities. We are currently doing investment due diligence on growth, mid-market, buyout, private equity strategy, potentially with a bit more focus on healthcare. And within our portfolio, one of the themes that we closely follow is growing aging population, which then translates into growing demand for good quality healthcare services. So having more exposure to this type of opportunities will be really good for us. And we are also looking, I'm very excited about this, but we are also looking at some co-investment opportunities in private equity growth. So we'll definitely keep the shareholders up to date on that front.
Fantastic. Thanks, Dania. It was great to chat.